before we get into actually the topic of this chat, we were just talking in the back. I can't believe it's 15 years, January 1st, that you will be the CEO of Bank of America. I mean, give us the tips to leadership longevity. I mean, how do you do this?
Age, gracefully, I guess. Look, I've got a great team, and that's the number one thing. To be successful across time, you have to have people who do the work well, and keep the energy up and keep the drive. And I'm lucky to have a great team, and every day we unleash 215,000 people to go out there and do their job, and they do a great job.
Talk to us, so drilling into this topic, these topics a little more, we've heard a real sense of optimism from the folks on this stage. You know, my first interview of the morning was with Apollo CEO Mark Rowan. Optimism on this new administration, what they can do in terms of regulation, unleashing the power of business. Do you share that optimism?
Well, I think it's clear that the market has moved in anticipation of all that. Now it has to be executed upon. But I think what's really driving the fundamental activity in the economy is the things that make America great. Capitalism, a consumer knows how to, is employed and earning money and spending, a credit which is widely available. And, those are what drives this. Capital markets is deep and open and recycling capital, and investors like all the people here putting it to work. That's what makes America great, and having a set of policies to enhance that is a good thing.
One of the benefits of being the CEO of Bank of America for 15 years, you get to work with different administrations. People call you for advice, and there was a photo that I found just as I was prepping for this, you sitting next to then President Trump during the COVID-19 pandemic. You worked with him. Do you have confidence that he and his new, as someone else said in the here today, cast of characters can execute to the extent that it justifies this market optimism we're seeing?
Well, I think they should be able to. They've got the experience, and so that was in the middle of COVID. It was literally the day which he issued the order cutting flights off from outside because of the dynamics. So, yeah, I think the thing that's always interesting about a second term of a administration, this one had 4 years between it, is that they come in without having to go through all the work the first time, which the work the first time has a couple dimensions. One's the personnel part of it, usually takes a lot longer. And there's been transition planning commissions formed to try to speed that up, but you got to fill a lot of jobs, 4,000 jobs. You also have to figure out, what policies you're going to have right out of the box. You have to figure out who you have to reward for things that got you here, and all that is important. When you do it the second time, especially when you have time to think about it, I think it's they should hit the ground running, and I think that's what they plan to do.
The cast of characters, we're learning a little bit more about who will serve the administration. They have a different profile than what they look like in the first term. They appear to be feather rufflers. I mean, do you have concerns as a leader that they may ruffle some feathers on a global scale and it impacts businesses?
Well, I think the idea of the United States is an idea, and it's an idea which is really unique in the world. And it is an idea which has been, a president elected now for 47 times, I guess might be 47 different people have served in the office 47 times. So if you think about it, and you think about the elections across time, there has been a lot of debate about who this is or who that is, all across time, and all that will play out. At the end of the day, when you get in office, you have the responsibility for 300 million plus people. You have responsibility of being one of the leading companies in the world. You have the responsibility of a $6 trillion operating budget, a $2 trillion debt, or $1.8 trillion that's got to get managed. All these things become the real issues. So I think people often put in, even when Reagan got in with a huge landslide win, he was going to do things that if you actually go back and look, a lot of them were never done, because at the end of the day, the enormity of the task gets to you. Can you lean the policy? Absolutely. Can you change things? Absolutely. Can you lean the regulatory process? Absolutely. But at the end of the day is the will. You govern all the people, and that takes work. This group that coming in has experience, haven't gone through it before, and I think that will help them speed up.
I know Mark at Apollo, he's had the ear of some of the transition team. Have you talked to some of the key members, key players? And if so, what have you told them? And have you had the opportunity to talk to President-elect Trump?
Any conversations like that I wouldn't share with openly.
What would make it this, fair enough, this group, what would you tell them? What do they need to do in that first 6 months or that first 100 days to unleash the power of business?
I think the issues that people think about, the other side is the opportunities for America. It is the place to invest on a global basis right now. because it has a better set of rule law, it has a good rule law, it has a set which regulates how you get paid and the rules of owning stock and all that stuff, a good rule of law, it has a talented group of people, has a lot of capital, and has a big final demand. In other words, our 300 million plus citizens consume a lot of stuff. And then it has incentives built in to help enhance that through tax provisions on bonus depreciation, things like that. So I think that first order business is to play to our strengths. We are the innovation capital of the world. We are the capitalist capital of the world. We are the place where people can be, you 15 years ago that decide to do something and create a company or do something that can get done.
I envision myself here, Brian.
Yeah, that's
talking to you.
We'll have a discussion about that afterwards. So I think you have to remember that those things are what makes America great, and enhancing those is what people have to do. So what do they need to do? One of the things they have to make sure is that we start to handle the budget better. It doesn't mean there's a crisis right now, but at the end of the day, we have to shape the budget back into a more normalized budget. Interest rates are going to be higher, debt carry costs are going to be higher. A $1.8 trillion deficit on an annual basis is equal to the GDP. That one-year deficit, the entire GDP of the country of Australia. So think about the size, scale, and scope and the amount of resources that pulls out to fund. So they have to think about how to get that in better balance. That is not new news. That's been going back to multiple administrations have tried to figure out to get that balance back, and then COVID hit and threw it all asunder, and now we've got to put that back together. So one is they've got to figure out how to get government spending and revenue more aligned. They've got to deal with the tax laws that come up for renewal extension, and we got to do that, and we got to be careful not to impact one of the advantages the U.S. has is a reasonable set of tax provisions for corporations. That's why money comes here, and then we got to keep working on making the conditions of work. If you're trying to solve housing, you got to build more housing, and the way you're going to build more housing is to figure out how to create the incentives for communities to permit more activity. And that is a tricky thing because it's local community control, but the federal government can create the incentives and drive it. So a lot of these issues, they have the power of incentive production, meaning through tax code to the people who do the work, or through, saying to the community, you do that and we'll new school buses, whatever it takes, but you got to get, demands, the supply side of a lot of stuff built out.
A lot of folks in this room have a portfolio that is vastly worth more today after the election than it was 5 or 6 or 7 days ago. And a large part of that is this belief that the administration will come in and cut taxes. But can they come in and cut taxes at the same time where the deficit is going up and to the right seemingly every single day?
I think getting the balance right of spending containment, tax receipts, clarity and getting the condition there, whether it's cutting rates or simplifying the code and generating other ways to make sure you have it. But you need more revenue, and you also need to manage expenses. There's no other way to do it. In your household budget, you have the same question. I've got $1 coming in, I've got to have less going out to have come in if I want to have.
Yeah, I got alerts from BFA. It tells me I'm doing.
Or if I'm a government, I at least got to have $1 coming in and $1 going out.
Sure.
And the problem right now is we're $1 coming in and 30% of it's going out. 30% more, 130% is going out. So I think the way they're going to do it is going to be interesting. I think the ability to cut a lot of revenue producers will have to be carefully crafted with the amount of growth that the pie grows. And that's the conundrum you always have, which is saying if you cut rates, you've got to be assured that you're going to get more volume through that lower rate structure to get there. There's ways to do that. There's ways to go back all the way to the early 80s where they said you can cut the nominal rates and reduce the amount of loss in the system and build a lot of it. There'll be a lot of techniques there, but that is a hard process to manage.
Well, part of it, if they want to cut the deficit, doesn't it mean they have to cut government spending? And then look, maybe Elon is onto something with his government efficiency program.
I think it's all about growth rates. Mm-hmm. You have to slow down the growth rates. And so in companies around this country right now, we had an inflation-induced growth rate in expenses. We're all sitting there saying, wait a second, we have to manage that back to a more normalized growth rate in expenses given that the inflation's through the system and coming down. That the government has to do, that's what everybody has to do. And the trick of that is you've got to be able to do that realizing that you came from X to about 30% more than X, to give you a sense in our company in a round of nominal dollars, and then you got to flatten it out. People remember this on the wage side and things like that, and that's going to be tough work. But there's a lot there. I mean, believe me, any company, we look at our company, we can always take expenses out. Any enterprise can be a lot more efficiently run. There's no question. Apply technology, reductions and increases in spans of control, all the thousands of techniques the private sector use, I'm sure are applicable in government.
Part of your role too, I mean, you have conversations with everyone, but a part of that is, you've talked to Fed Chief Jerome Powell before, over I'm sure many years. How concerned are you that the Fed under this incoming administration is challenged?
I think at the end of the day, I think that our Federal Reserve, an independent central bank, is a good place to be. The debate is about what's the range that Congress created the Fed. A lot of people think it has anything to do with executive branch. Congress created the Federal Reserve Act, and the Fed was created out of it. And it was to provide its mandate, which is employment, prices, inflation, those types of things. And I think that they got to continue to work on that. I think that having that direct discussion at various times with people, having that monetary policy as another independent check with a purview of Congress overlooking it by who they appoint and by the annual testimonies or periodic testimonies, there's a control system around it. And so I think we have to be careful, because if you look at other countries around the world that do not have that, it never works out as well as one that is.
Well, that raises the next question. I mean, should the president have a say in monetary policy?
The president's a job owned the Fed for years. That's not a new concept.
Yeah. I mean, in your view...
Just like I can have a job owner too, but at the end of the day, the people have to go do their job, that's their job, is to figure out where rates should be set.
Has Jerome Powell done a good job in your view?
I think he has. I think he's done a good job of working through the system. I think the reality was, were they too late to get to inflation? Sure they were. They were in unprecedented times. They didn't see it, the transitory, all that discussion. Then they came back, and now you're seeing what's happening is inflation's coming down. Unemployment's been relatively steady. Employment's been very strong. And so you're managing that outcome. And the question is, now's the hard part again. The hard part was to get started. And the hard part now is how to manage it down so you don't overshoot. And I have more worry in some respects to the downside, i.e. overshooting now, than I did before, because the balance is tricky, because the data will float around on you, and what you thought was precision becomes less precise when you look back. So just think about the amount of restatements in jobs, and the amount of restatements in some of the GDP things, just because COVID, we have to remember, was completely different than anything else. The idea that you had all the stimulus come in, that you basically spackled over, think of a hole in the wall, a hole in the economy, you spackled that over and made it level across the whole U.S. economy. This wasn't a narrow area we had to fix or do something. You had to do it across the whole U.S. economy. And the amount that was spent on that, had to win that war. We won the war. But the problem is we not trying to win, so we added more and more to it, which really created a lot of inflation impact. That has to be taken under control.
Are you concerned that inflation resurfaces next year?
I'm probably less concerned about that in the near term than I am making sure that we don't hurt the American consumer's confidence. And I think the consumer was slowing down in the late summer. We saw it. It was concerning me because I thought it was slowing down to the point where it may be underneath what would imply a stable 2% plus or minus growth economy, lower inflation. The good news is, as we came into September and October, if you look at the 2 months together, you look at October, it looks like it's leveling out. And the expectations of our consumers to spend more in the holiday season, up 7%, which is good. But that growth is running around 3% plus or minuses if you average the 2 months, 3, 4. That's where it should be. And the danger is if you dispirit the American consumer by thinking the future is not going to allow them to earn, be employed, spend, it's hard to get them back in the game. And that's what took so long after the financial crisis, to get the confidence back in American consumer. I think that confidence you saw it come up when the Fed says we're going to cut rates. Even before they cut them, the consumer confidence moved up a little.
How many rate cuts?
We're basically 1 more this year and 4 next year. And then they get that a Fed funds rate that sort of stabilizes in low threes, 3.25.
What do you think that does to savers? Consumers for the past 4 or 5 years earning a lot on a good CD. Does that change?
There'll be a steepness to the curve, and so I think, the Fed, the 10-year, 7-year, 5-year, those. If you have 3.5 and they're 4.5-ish, somewhere around that, which is kind of what the implied normal rate curve shape would be. They'll as people go out duration, there'll be strong returns in the Treasury yields and stuff. And you saw a lot of our clients in Maryland stuff go into the Treasuries, and a lot of deposits went outside the banking system. Not overall among all the consumers, among the wealthiest consumers. If you look at the 20 people here in 20 who are still here today, if you look at what happened is the consumers the lower average balance accounts are still multiples of where they were in 20. The consumer in the highest, like between 100,000 and a million, are down 15% because they put the money in the market because it was excess money. That all happened. It's stabilized now. Deposits have been growing for the last 5 quarters in the industry and our company. And as you look at that mix, that means consumers are rational. So what will happen is the dividend yields of equity plays will become more relevant. The core interest rate achieved in a money market fund or a CD will be, maybe it won't be the highest peak it was, but that was based on a rate structure that was completely inverted. It'd be better if the rate structure be normalized and getting that rate by going out some duration. So it'll make the equivalent to balance. Most importantly, a real rate structure, which we haven't had in 17, 20 years, will also, I think, put discipline into financial decisions because there'll be a real cost of capital. And that's what you're seeing. So despite the market running up, you're also seeing a discipline come back into the cost of capital, which will play through.
Part of the reason why, in my view, you've been CEO of Bank of America for 15 years, you've always been level-headed. Like, I mean, you tell people like it is. I mean, but to me, this market move feels too euphoric. I mean, is it justified in your view? There's a lot of people in this audience have never seen, I think, some of the moves in stocks they have seen over the past 5 days. Like, what's your, I guess, word of caution to this group?
Well, we look at the one-day pop. It was actually not the highest pop we'd had. So in 2011, we had a pop that was more gross dollar value of market cap, believe it or not, even though we had more shares and it was less. So I think these things do happen and the market reacts. The market's a very short-term mechanism. Ultimately, the equity market's supposed to long-term value, but it don't discount long-term value, but they're very narrow in the trading ranges. And so I think if you get to the people, our experts who predict what will happen long-term, it's going to be based basically on earnings growth. And so the question will come down, will the policies of the incoming administration create economic growth, which will then result in earnings growth, and whether if the companies are managed well, they'll get it. That's what will drive the next round of the market. The valuation pop that's happened over the last year and another chunk of the last 5 days, is pretty unusual. Part of it was recovery from last year stuff, but it's pretty unusual. And so we got to kind of grow into it now, and that's the earnings growth has got to come.
I can hear my banking team, our banking team at Yahoo Finance, Dan Fitzpatrick, our editor, and David Hollerith watching this, probably saying, ask Brian about bank stocks. I mean, bank stocks have been
always undervalued.
Always undervalued. You've been telling me all these years undervalued. But, I mean, they've been flying.
Yeah.
Over the next couple quarters, what could this administration do to justify this run in bank stocks? Is there a regulation you're looking at? How can they make your life easier?
I think the simple response that we've seen in the market across the board has been, can we get this regulation done right and done in a way that both meets the needs of the economy and the capital structure of banks that support that economy and in the needs of safety and soundness. And as that pendulum swings and swings and swings over time, the idea is sometimes we swing this way and sometimes we swing that way, and now I think the expectation is. And so that's one thing. The second thing is getting deals through, and that's, you've heard.
It'll impact your M&A, your investment banking?
Not us, because we can't do any, but it'll be on the investment banking side. And so I think there's that instantaneous reaction. Now it's got to fall through. But if you look, when we looked at Basel III in the industry, the idea of the finalization of Basel III, the increase in capital, and this isn't theoretical. We made it clear that this doesn't make any sense, and so there's a reproposal to bring it down another chunk, and we'll see where it ends up. But the obvious issue was if you had our company needing, really, $30 billion more capital for the same risk, you basically are taking our ability to lend $300 or $400 billion out there.
Do these regulations get scrapped, Basel III?
I don't know what will happen. They're already being amended and stuff, and so I think cooler heads will prevail. We'll see what happens. But I think our job as an industry is to make sure that we do it in a way that is fair from all aspects. Fair to the companies so they can support the economy, but and then fair to the consumers, fair to the investors, and fair to the American economy. And also, in the end of the day, our industry is capitalized the best in the world, liquidity best in the world, and we have shown the resiliency through last year's crisis or the earlier backs and forth in the world that shows you that I think we got it pretty much right. So I think the amount of cap we have now is pretty much right. That's been said by every Fed chair. It's not, take my word for it. And rather than why are we messing around? And why are we following countries that are still struggling to figure out the right answer? Just let it go.
How, you and I have talked about this in the past, how just not good these Basel III rules, if they went fully implemented, like, what would they mean to a bank like yours?
At the end of the day, if you think what's going to keep pricing tight on credit to small businesses and medium-sized businesses, and you said you're going to increase your capital for the same activity, what would happen is two things. One is the cost of capital of those businesses would go up and their worldwide competitors would go down. You'd say, well, how a $100 million revenue company, if we have to increase the rate they pay on their loan, well, that's not a problem because all the other banks are in the same boat in the United States. Very few companies with 100 million, 200 million of revenue compete only in the United States now. They're tied to the worldwide economy, whether they export to it, whether they supply parts to it, or whether they supply parts to an American company, can also get those parts from other people. And so the reality is this had a real economy impact that I think was not thought through. And that's why we stood up and said we don't think these rules are right as an industry, and we made it clear. And then what happened is they were moved a bit, and we'll see what happens next.
Last one, Brian, real quick. You're one of the most respected leaders in the banking industry. If you get a call from the president to serve in this administration, would you do it?
I've got a great job and a great company to run.
I don't know.
I think there are people who can work in administration, do a great job, and our job is to make them successful. Because at the end of the day, as people ask me about the elections, our company, the oldest part's been around in every election except for when George Washington got elected. Mm-hmm. So, and we'll be here far beyond this thing. And so our job is to make America successful, or add to America's success and help give ideas to make it even more successful. So I can do that as well from sitting in this chair as I can sitting in any other chair.
Fair enough. We thank you for sitting in that chair. Brian Moynihan, the CEO of Bank of America. Appreciate it.
Right. Thank you.